Hello, in this lecture we will define gross profit method. According to Fundamental Accounting Principles, Wild 22nd edition, the definition of gross profit method is procedure to estimate inventory by using the past gross profit rate to estimate cost of goods sold, which is then subtracted from cost of goods available for sale. This gross profit method is basically a way for us to calculate what the cost of goods should be without doing a physical count, and it can be used in a couple different ways. For example, if we have a perpetual inventory system, we may need to do a physical count at the end of a time period to determine how much we need to reduce the inventory by and how much to record in terms of cost of goods sold. We may use a method such as this to compare to in order to see if the decrease in inventory is solely due to sales or if there's some type of shrinkage. This would give us an estimate to help with something like that. The way to calculate this would be we're going to take a sales per unit or the sales from the prior time period, compare that to the cost of goods sold, and see the gross profit. Then we're going to calculate the percentages. We can calculate the gross profit percentage by taking the gross profit or the gross profit per unit divided by the sales. That would give us 25 over the 100 in this case, or 0.25 or 25%. That means that we have gross profit percent here 25%. If we say that the 100% of sales is of course 100%, that means that the cost of goods sold would have to be the 75%, or we could also calculate that as the 75 divided by the sales of 100 to give us that 0.75 or the 75%. Once we have that percentage, we can use that to estimate what the cost of goods sold would then be by taking whatever the sales is for a particular time period. We're going to take the sales number, total sales in this case, multiply it times the percentage for cost of goods sold, and that would give us the cost of goods sold that we would expect in relation to the 200,000 in sales that was done for that time period. We can then use that cost of goods sold number to see what the ending inventory would be as well. We would do that by taking the beginning inventory before this time period, subtracting out the cost of goods sold, and that is what should be left at the end of the time period. We can compare that to a physical count if we then took the physical count and see if this estimate is close to what the actual physical count is. If there's a difference and the physical count is less, it may be due to some type of shrinkage or theft or spoilage or something like that.